Many investors struggle to find the right balance between risk and reward, often ending up with portfolios that underperform. It's frustrating to see your hard-earned money not working as efficiently as it could, or in some cases, losing value. You may have tried picking individual stocks, only to be disappointed by unexpected downturns in market volatility. What if there were a way to simplify your investment strategy while still achieving high returns? Could there be a method that offers both diversification and growth, reducing risk and increasing your chances of success? The answer lies in exchange-traded funds, or ETFs. But with hundreds and thousands of options, which ETFs should you choose to set yourself on the path to becoming a millionaire? In this video, I'll show you the 6 best ETFs to buy and hold forever, with the potential to turn a simple investment of $10,000 with a weekly $25 contribution into a solid retirement portfolio, ranging from $500,000 to over $4 million. In the end, I will show you how to create a portfolio of these ETFs to reduce risk and still achieve a $1 million valuation that pays over $50,000 in annual dividends. But first, my criteria for selecting these ETFs. So how did I pick these top ETFs? Well, I focus on a few key things. First up, I want diverse exposure. I want ETFs that cover different sectors like tech, home building, and dividend stocks. This way, you're not betting all your money on one horse. Next, growth potential is crucial. I choose ETFs with strong historical returns and future growth prospects. Dividend yield and growth are also key. I love ETFs that pay steady dividends and increase them over time. I also look at low expense ratios to keep costs down, and strong performance metrics like high momentum grades. This combo sets you up for long-term success. Based on these criteria, let's kick things off with the 6th ETF on my list, the iShares Core Dividend Growth ETF, or DGRO. This ETF is perfect for those looking to blend steady income with the growth potential of dividend-paying stocks. DGRO is managed by iShares, a well-known name in the investment world, and it was launched in 2014. This ETF tracks the Morningstar US Dividend Growth Index, which focuses on US companies with a consistent history of dividend growth. It has an impressively low expense ratio of just 0.08%, making it a cost-effective choice for long-term investors. It has a huge $28.59 billion in assets under management. Over the past decade, it has achieved a price return of 143.57%. It has a momentum grade of B+, indicating solid performance trends. With a risk grade of A-, DGRO is considered relatively stable compared to other equity investments. Its liquidity grade of A+ ensures that investors can easily trade shares without significant price impacts. DGRO's strategy is centered on capturing the benefits of dividend growth. It offers a current dividend yield of 2.29%, providing a steady income stream. Over the last decade, dividends have grown at an average rate of 9.30% per year, and the share price appreciation has averaged 7% annually. Based on these metrics, suppose you start with an initial investment of $10,000 and make annual contributions of $1,200, which is about $25 each week. After 1 year, your investment would grow to around $12,129. After 10 years, you could be looking at approximately $43,671. Fast forward 20 years, and your portfolio might grow to roughly $134,664. And after 30 years, an impressive $402,778. By year 30, you could be earning around $15,959 annually from dividends, which translates to about $1,330 per month. The total value added to your investment would be $356,778. with capital appreciation contributing $231,399 and reinvested dividends adding another $125,379. The 5th ETF on my list is Vanguard S&P Small Cap 600 Index Fund ETF Shares, or VO for short. Run by Vanguard, one of the most trusted names in the investing game. Launched back in 2010, this ETF aims to mirror the performance of the S&P Small Cap 600 Index. Basically, it's a basket of small cap stocks, which are companies with a smaller market capitalization. The best part? It has an expense ratio of just 0.10%, meaning you keep more of your money working for you. The ETF has about $4.43 billion in assets under management. Sure, it's a bit more volatile with a risk grade of C-, but that's the trade-off for higher growth potential. Plus, it's quite liquid, making it easy to buy and sell shares. Over the past 10 years, it has delivered a price return of around 122.97%. So what's the strategy here? The ETF focuses on small-cap stocks, which historically outperform larger ones over the long haul. With a momentum grade of A, this ETF has some serious upward trends. It offers a dividend yield of 1.37%, not too shabby for some extra cash flow. Over the last decade, dividends have grown by an average 13.22% per year, and the share price has appreciated by 7.98% annually. That means you're getting both income and growth. You might be wondering why VO is such a great pick for the long haul. Small cap stocks are the underdogs of the market. They have more room to grow compared to the large cap counterparts. And with only 5.91% of its assets concentrated in the top 10 holdings, the ETF offers broad diversification within the small cap space, reducing the impact of any single stock's poor performance on the overall portfolio. Let's look into some future projections that show VO's potential for wealth generation. Suppose you start with an initial investment of $10,000 and make annual contributions of $1,200. After the first year, your investment would grow to approximately $12,135. Fast forward 10 years, and your portfolio could be worth around $44,291. After 20 years, your investment could potentially grow to $144,626. And after 30 years, it could reach an impressive $505,385. After 30 years, you could expect to receive dividends totaling $26,646 annually, translating to monthly dividends of $2,220. The total value added to your investment portfolio would be $459,385, with capital appreciation contributing $294,988 and dividend reinvestment adding $164,397. Next up, we have the Schwab US Dividend Equity ETF, or SCHD. If you're looking for an ETF that combines the stability of dividend-paying stocks with the growth potential of the US equity market, this one should definitely be on your radar. SCHD is managed by Schwab, another powerhouse in the investing world, and it's been around since 2011. This ETF is designed to track the performance of the Dow Jones US Dividend 100 Index, which means it focuses on high-quality US companies that have consistently paid dividends. What's great is its super low expense ratio of just 0.06%. That's a tiny fee for managing your money. Let's talk numbers. SCHD has a massive $57.48 billion in assets under management. Over the past decade, it has delivered a solid price return of 116.36%. It's a bit less risky compared to some other options, with a risk grade of B-, and it's incredibly liquid, so you won't have any trouble buying or selling shares when you need to. SCHD's strategy revolves around dividend-paying stocks. It's got a momentum grade of B, which means it's been performing well. The current dividend yield is 3.49%, offering a nice income stream for investors. Plus, over the last 10 years, dividends have grown by an average 11.01% per year. Combine that with an average share price appreciation of 7.64% per year, and you've got a strong case for long-term investment. Why should you consider SCHD for the long term? Dividend-paying stocks tend to be more stable, especially during market downturns, and they provide a steady income. SCHD's turnover rate is 28%, which is pretty efficient. With 39.82% of its assets in the top 10 holdings, it's somewhat concentrated but still diversified enough to spread risk. Plus, it pays dividends quarterly, giving you regular income to reinvest or spend. Now, let's look at the future projections for SCHD. Suppose you start with an initial investment of $10,000 and add $1,200 every year. After 1 year, your investment would grow to about $12,313. After 10 years, you could be looking at around $51,239. Fast forward 20 years, and your portfolio could grow to approximately $201,487. And after 30 years, a staggering $879,307. Dividends play a huge part in this growth story. By the end of 30 years, you could be earning about $68,628 annually in dividends, which breaks down to $5,719 a month. The total value added to your investment would be $833,307, with capital appreciation contributing $417,980, and reinvested dividends adding another $415,327. At number 3, we have SPDR S&P Home Builders ETF, ticker symbol XHB. If you ever thought about riding the wave of the housing market without buying a house, XHB might just be your golden ticket. This ETF lets you invest in the home building industry, which can offer some serious growth potential. XHB is managed by SPDR State Street Global Advisors and has been around since 2006. The expense ratio is a bit higher at 0.35%, but the potential return can make it worth your while. XHB's strategy is all about capitalizing on the growth of the home building sector. With a dividend yield of 0.61%, it's not really an income play, but it makes up for that with capital gains. The dividend growth rate over the past 10 years has been a hefty 18.36% per year, and the share price appreciation has averaged 13.71% annually. This means you're looking at significant growth potential. Why should you consider XHB for the long term? The housing market has historically been a strong driver of economic growth. With XHB, you're investing in a diverse range of companies within the sector, reducing the risk compared to investing in individual stocks. Let's get into the future projections. Suppose you start with an initial investment of $10,000 and add $1,200 each year. After 1 year, your investment would grow to around $12,632. In 10 years, you could be looking at about $62,408. Fast forward 20 years, and your portfolio might grow to roughly $274,610. And after 30 years, you could see an astonishing $1,193,816, making it our first ETF to reach $1 million valuation. By year 30, you could be earning around $23,430 annually from dividends, which equals about $1,953 per month. The total value added to your investment would be $1,147,816, with capital appreciation accounting for $1,014,644, and reinvested dividends adding another $133,171. The important thing here is that it does carry some risk due to the volatility of the housing market. In the end, I will show you how to create a portfolio of these ETFs to reduce risk and still achieve $1 million valuation that pays over $50,000 in annual dividends. At number 2, I have the Fidelity MSCI Information Technology Index ETF, or FTEC. If you're excited about the future of technology and want to be part of that growth, FTEC is a fantastic way to get in on the action. This ETF gives you a slice of the tech sector, which has been one of the fastest growing parts of the economy. FTEC, managed by Fidelity Investments, has been around since 2013. It tracks the MSCI USA IMI Information Technology Index, meaning it covers a broad range of tech stocks, from giants like Apple and Microsoft to up-and-coming innovators. With an expense ratio of just 0.08%, it's a cost-effective way to invest in the tech sector. The ETF has a massive $11.01 billion in assets under management. Over the past decade, it's delivered an eye-popping price return of 494.49%. This ETF has a stellar momentum grade of A+, reflecting its strong performance trends. While it has its risks, it's worth noting that tech stocks can be more volatile, but they also offer significant upside potential. FTEC's strategy revolves around capturing the explosive growth of the tech sector. It offers a dividend yield of 0.65%, which might not seem like much, but remember, tech stocks are often more focused on reinvesting profits to fuel growth. Over the past decade, dividends have grown by an impressive 19.08% per year, and the share price appreciation has averaged a stunning 19.21% annually. This means you're getting both growth and a bit of income. Why should you consider FTEC for the long haul? The tech sector is at the forefront of innovation, driving economic growth and transforming industries. With 61.73% of its assets in the top 10 holdings, it does have a higher concentration, but this is typical for tech ETFs given the dominance of major tech companies. The focus on tech giants, combined with emerging tech players, offers a balanced approach to capturing growth. Now let's look at future projections for FTEC. Suppose you start with an initial investment of $10,000 and add $1,200 each year. After 1 year, your investment would grow to about $13,186. After 10 years, you could be looking at an impressive $92,108. Fast forward 20 years, and your portfolio could grow to approximately $594,032. And after 30 years, a massive $3,660,128. By the end of 30 years, you could be earning around $19,112 annually in dividends, which breaks down to about $1,593 per month. The total value added to your investment would be $3,614,128, with capital appreciation contributing a massive $3,499,386, and reinvested dividends adding another $114,742. And now, finally, topping our list at number 1, we have the Vanguard S&P Small Cap 600 Index Fund ETF shares, or VOV. This ETF is a great way to gain exposure to small cap value stocks, which can offer substantial growth and dividend potential. This ETF was launched in 2010. It manages $1.33 billion in assets. Over the past decade, it has delivered a solid price return of 92.47%. The strategy behind VOV is to capture the growth of undervalued small cap stocks. The ETF has a current dividend yield of 2.27%, providing a decent income stream. Over the last decade, dividends have grown at an average rate of 16.87% per year, and the share price has appreciated by an average 6.39% annually. This combination of growth and income makes VOV an attractive option for long-term investors. Why should you consider VOV for the long term? Small-cap value stocks often have more room to grow compared to their larger counterparts, and they can offer higher returns over time. VOV has a turnover rate of 45%, indicating active management to stay aligned with its index. With only 8.82% of its assets in the top 10 holdings, it offers broad diversification within the small-cap value space, reducing risk. Now, let's look at some future projections for VOV. If you start with an initial investment of $10,000 and add $1,200 each year, after 1 year, your investment would grow to about $12,066. After 10 years, you could be looking at around $45,889. Fast forward 20 years, and your portfolio might grow to approximately $237,249. And after 30 years, an incredible $4,286,732. Dividends play a significant role here as well. By year 30, you could be earning around $1,189,088 annually from dividends, which translates to about $99,091 per month. The total value added to your investment would be $4,240,730, with capital appreciation contributing $731,364 and reinvested dividends adding another $3,509,365. But does this mean you should go all in and invest all your money in these ETFs? The answer is most definitely no. For instance, this ETF has a higher risk grade of D+, reflecting the volatility typical of small-cap stocks. So what's the best scenario here? That would be making a portfolio of these ETFs. By spreading your investment across all 6 ETFs, you can create a balanced portfolio that minimizes risk while maximizing growth and income. Here's how the numbers play out. With a combined portfolio, you get a portfolio dividend yield of 1.78%, which is solid. The average dividend growth of 14.92%, and the average share price appreciation of 10.76%. Let's break it down. Suppose you start with an initial investment of $10,000 and add $1,200 each year to this portfolio. After 1 year, your portfolio would grow to about $12,458. Fast forward 10 years, and you're looking at approximately $55,840. After 20 years, your investment could grow to around $230,362. And after 30 years, it could reach an impressive $1,009,200. By year 30, you could be earning consistently around $50,193 annually from dividends, which translates to about $4,183 per month. The total value added to your investment would be $963,200, with capital appreciation contributing $671,836 and reinvested dividends adding another $291,364. Want to know how to turn a one-time $25,000 investment into over $10 million that pays $10,000 every month? Click the video on the screen to find out.